Hello. Today we will be discussing the two different firms, Pepsi and Coke. Our main goal is to see how they both stack against each other and how well Pepsi is doing. Today we will be hearing from Katie Horan, Jessica McNabb, Parker Zach, and Christopher Wall.
Hello, my name is Parker Zach, and I'll be introducing PepsiCo's internal analysis. A lot of stuff happened this previous year, not all of it represented in some of the other financial statements. So we're going to break it down and go through three major concepts in this presentation. We're going to go through their cash and cash equivalents, and more specifically cash flows. We're going to be looking at their actual financials and their overall performance for the 2010 to 2011 year. Once again, a lot of stuff happened, so this is going to be in brief, and the paper will go further in depth. Hope you enjoy it. Stay tuned. This is the cash flow portion for the Pepsi internal analysis. And as you can see, it's not data we actually gained from the original SEC documents that we were utilizing. We acquired this data through the Bloomberg database, which showed three different forms of cash flows which we felt were really pertinent to this issue. So we felt this would be the best time to start explaining them. You can follow along on the graph to the right on this presentation to kind of understand what my analysis is explaining. The first one, if you look to your right, actually is the top blue line, which is the operational cash flows, which showed a positive gain in cash inflows. What this means is that Pepsi was gaining a lot of money, more so even than the previous year, and actually holding on to it. This should have led to a boost in their cash and cash equivalents. However, as we saw in the documents, that wasn't true. This is because the other two lines showing there. So we'll start with financials. Financials ended up having a $6 billion outflow. What that means is $6 billion Pepsi paid to other investors and creditors. We believe this to be from a massive issuing of bonds, which we'll discuss later. However, it's important to realize that along with the investment outflows that happened, as both of them made it so even though they had initially a large gain in cash and cash equivalents, they ended up with very little by the end of the year. Furthermore, the investments should be noted that they were for acquisition of northern bottling factories. So this isn't to say that the cash was utilized improperly, it just led to a less overall amount for that year, which could cause problems later on as they have less flexibility than if there's any more price shocks or any other type of market issues that arise. We'll go into further detail though on the bonds issue in the next slide discussing financials. The financials for PepsiCo are actually tie in directly with the cash flow slide from previous. As we stated in that slide, there was a major outflow due to paying off bonds that were issued in the previous year. What this means for financials is that while the previous year looked very well for financials, this 2011 year looked very poor because they had to start paying off all those bonds they issued. That was the first big issue for Pepsi's financials. They had a massive amount of new debt that they were starting to pay off. Even though that was probably done at the new interest rate, it still doesn't show favorably on the company, at least from that one individual part. There was also a secondary issue that affected Pepsi for this current year, and that was due to certain external forces outside of the company's control. They had a performance problem, which we'll discuss in the next slide as well, where it led to them being downgraded. Specifically, Davenport and Stifel Nicklaus downgraded PepsiCo's holdings from buy to neutral and from hold to neutral as well. Both of them actually a negative grade, which really isn't something you want to see in a company that just issue out so much in bonds. This could cause further damage down the road, but currently it looks like it's starting to stabilize. Important to note that the downgrades were to hold and neutral once again, meaning it wasn't an outright buy. So even though they're not highly recommending the bonds anymore, they are still worth clinging on to in case you invested in it. As the previous slide alluded to, Pepsi's clearly got some performance issues, and they are not going away currently. It's important to note that from 2009 to 2011, our data showed that they had a steady decrease in the common size ratio for their net income. What this means is that while on paper it looks like they've had increasing net income each year, compared to the size of the company at that time, it's actually less, and less. Not exactly something entirely positive to look at. This might have also played into effect for the downgrading by Davenport and Stifel when they lowered it from buy to hold and neutral, respectively. This is not to say all of Pepsi's performance issues are based on what they've done. There were also external forces during the 2011 fiscal year that really affected their bottom line as well. The two major issues that happened was an increase in agricultural commodities and oil. These two are major inputs for products by Pepsi. So this greatly increased their cost of goods sold, directly affecting their operating profit and eventually their net income. While they themselves are having issues internally, that probably had a greater effect than anything else, at least for this 2011 year. It's also important to note that from each year, there was a separate issue that looks like it was cutting into their net revenue and eventually their net income every time. What this means is Pepsi's trying to fix whatever issues they're having. They just seem to break the next part in the process each time. Hopefully with time they'll actually stabilize, which will lead to positive gains once again for this long-standing and venerable company.
Hello, my name is Christopher Wall, and I think it'd be very beneficial to go over a competitor of Pepsi, which would be Coca-Cola. Just getting the comparison can make a lot of sense and would help in future decisions. Right here we have the statement of cash flows for Coca-Cola. In looking back, we have seen that they did better in 2011 than 2010, as their cash equivalents went from 11.68% to 16%. That's a good improvement between two different years. We also see there is a decrease in finance activity, which probably means that they paid off a lot of loans and things like that, allowing them to be a little more secure for the future. This is very promising to see. It shows that Coke is making enough money to keep going ahead. They may recall bonds soon. This is either positive or negative. Negative to the bondholders, if you would say they would prefer to stick with their bonds and keep more of them. But at the same time, it shows that Coke is strong enough to buy back the bonds right now. They have enough cash to do so. And it's a very healthy position for a company to be in. Here we have Pepsi's financials. Here's their income statement right here. And we can see that their liabilities have gone up. This may be an issue to where they have increase of costs, and instead of passing that along to the consumers by charging more for the product, they decide to go borrow some money. We believe also that money could have been borrowed for a new bottling plant as well. It's nothing really too alarming. It should be alright. Overall, Coca-Cola sales did much better in 2011 than in 2010. Alone with a 37% increase of Coca-Cola brands in Russia shows that the company is selling a lot more and at a higher price. Their profit margin, it jumped from 34% to 19%. Kind of sad to see, as it shows that even though they're selling more, they are spending a lot more as well. So whether or not this is a good move on their part, we don't know. We should keep a look on it in the future. And then its current ratio, it shows that it dropped from 1.17 to 1.05, which means that they have more liabilities right now, which could be a sign that times are rough and they don't know how to make up for costs that they have.
My name is Jessica, and I will be talking about the similarities and differences of Coke and Pepsi's performance during 2011. Some of the main differences between the two companies' financial statements are in the cash and cash equivalents and in liabilities. During 2011, Pepsi saw a decrease in cash and cash equivalents of 3.14%, while on the other hand, Coke had an increase of 4.33%. Coke, however, saw a larger increase in liabilities. While both companies saw an increase in liabilities during 2011, Coke's increased by over 8%, while Pepsi only saw an increase of 2.8%. Both companies acquired new bottling facilities during 2011, so these differences could be due to how these acquisitions were financed, with Pepsi paying more from cash and cash equivalents, while Coke borrowed the funds necessary, thus increasing their liabilities. During 2011, worldwide agricultural prices increased, which caused an increase in cost of inputs for both companies. Pepsi, however, only increased costs by 1.5%, whereas Coke saw an increase of 3%.
Hi, I'm Katie Horan, and I will be addressing the last section of our case, which is the together section. Okay, so there are quite a few strengths and weaknesses that PepsiCo has. Initially, we'll talk about their willingness to cut selling and administrative expenses. In looking at their income statement, one can observe that the selling and administrative expenses decreased by 2% from 2010 to 2011. To us, this shows that they were willing to put shareholders first and try their best to maintain their current prices. Unlike Pepsi, Coca-Cola didn't touch their selling and administrative expenses, thus possibly contributing to their increase of liabilities. Another strength Pepsi possesses is that they increase their long-term assets, such as bottling plants here in North America. However, Pepsi does have some weaknesses as well. By having a decrease in total current assets, the company is less able to pay current liabilities. In the analysis of their financial ratios, it is seen that their current ratio in 2010 was 1.1055, and it decreased in 2011 to 0.9607. This is a weakness because they do not currently have the liquidable funds in order to pay off current liabilities. Coke, on the other hand, still holds a current ratio which is greater than 1, so they could still pay off current liabilities if they needed to. Now I'll talk about the last section of our paper, which is the suggestions that we have relating to Pepsi's future operating, investing, and financing activities. Initially, we suggest that it would be beneficial for Pepsi to find a way to decrease their operating activities. It is crucial that they raise their total current assets as soon as possible. Next, we have some advice regarding their investing activities. It is very wise of the company to invest in their future by investing in long-term assets. However, once again, we believe it very important to invest in such a manner that could increase total current assets for the firm. And lastly, our suggestion for Pepsi's financial activities. It is essential that Pepsi finds a way to increase shareholder confidence and make their larger investors happy with their performance. It also could be quite beneficial for the company to call back bonds with higher than market average interest rates. This would allow them to borrow money at a much cheaper cost. So that wraps up our case report and this presentation regarding PepsiCo and how they compare to Coca-Cola. We have faith that Pepsi has a bright future if they can apply our suggestions. Thank you.